Fantastic. Thanks for your kind words of introduction, David. Thanks to Finding Petroleum for having me here to speak, and thanks to all of you for coming. By way of introduction, if you don't know Bernstein, we are a Wall Street equity research firm. So while many of you are off producing oil and gas, we're producing research reports about oil and gas and which companies are exposed to the right themes and attractive investment opportunities as a result of that. And this year in particular, there's kind of been an interesting unconventional theme in the research we've been writing, and that is that pretty much anywhere across all of the equity research space, if you put the word shale in the title of your research report, about double as many people will click on it and read it. And the reason for that is just the sheer breadth of what unconventional supply is doing in the global picture. And that's going to be the main focus of what I talk about today. So we'll see how shale and unconventionals are impacting the supply side, how people are trying to look internationally, and how the ramifications just broadened to utilities, power, capital goods, transportation. About half of the S&P by market cap, when you add it all up, is affected. And the second thing I'm going to focus on is really nicely prefaced by David's introduction about technology. And some people today think supply could just grow forever based on this new technology, and both presidential candidates actually agreed that the US could achieve energy independence, which we don't actually think will happen. Quite a long way away from that. So that's going to be the second part of my talk, and you're going to think I'm a big misery guts because I'm going to tell you that the technology is great, but you shouldn't take it out of proportion. So let's just start with the recap. I'm sure a lot of this is very familiar to you. US gas supply looked to have peaked in around 2001 at 61 billion cubic feet a day, and over the first half of the 2000s it started declining, and gas prices rose from $2 an MCF to between 7 and 14, and then in the late 2000s, that top bar in the top right-hand corner of this slide started ramping up shale gas production, today at 30% of US gas supply, and with it the price has come right back down to $2.50 per MCF, one of the lowest levels in the world. And likewise with liquids in the United States, we had a peak of about 10.8 million barrels a day in the 1980s, and declined steadily to a low point of 6.4 million barrels a day in September 2008, which a lot of you will remember is the kind of the all-time peak nominal terms oil price, $150 a barrel. And since then, the Bakken, the Eagle Ford, other liquids-rich shales have just restored that resource curve. And out to 2015, the US could grow to 10.6 million barrels a day under our estimates, which would be today the greatest liquids-producing country in the world. So just a phenomenal shift in the resource curve. And the opportunity for the services industry, helping the industry develop this, is not lost, right? There's just been an explosion in spending on developing these shales in North America. So $55 billion is what was spent last year. If this was a country in the world, if shale spending in the US was a country, it would probably be the 50th largest country, right, by GDP. And what this is just expensive wells, $7 million per unconventional well in the US versus maybe $1.5 million for a typical conventional well. And as David said, longer frac stages, a doubling of the rig count to 1,850 rigs now operating, 60% of them horizontal, longer laterals, more fracs. The capital escalation is really significant. So that kind of completes the rough overview of what has happened with US shale. And I said before, I'd like to focus on the implications. What does this mean for different sectors, different commodities, different market dynamics? So I'm going to start that with the chart that I look at first thing when I get into the office every morning. And this is a set of indices of commodity pricing and equity index pricing, and then we've created our own indices of different market sectors within the oil and gas world. And normally I look at this on a weekly basis to see what's moving in different directions, but here you can see the movements in pricing and these indices since the start of 2011, so almost 2 years. And what I'm going to say is it's impossible to understand this trend without thinking about unconventional supply in North America. So look at the oil prices, those black bars in the middle of the chart first. You've got Brent, the global oil price, up almost 20%, and over the same time, the US oil price down 4% at Cushing, Oklahoma. And likewise with gas markets, the MVP gas price in the UK, sorry for your winter gas bill, up to $10 an MCF today. And in the US, we're down 34% to $3.3 an MCF. And then even within the individual subsectors of oil and gas, these trends have affected returns, right? So North American E&Ps are towards the right-hand side of this chart. They're some of the worst performing companies when you index them, and their counterparts in Europe are up 2%. Likewise, refineries in the US, great beneficiary of lower input prices and lower power prices. And they're the best performing sector, possibly helped by some acquisitions. Whereas European refiners are still down in the doldrums. And if you'll permit me, this one maybe gets a little bit tenuous, but you'll notice the S&P of US equities is up. That's the light blue bars on the very right. While in Europe, equity markets are down. In emerging markets, equity markets are down. In the UK, equity markets are down. And obviously this isn't all due to shale, but it's kind of worth pointing out that you give a real stimulus to your economy when energy costs are $800 million lower every day, and you create 600,000 jobs in shale. So that's why investors are just phenomenally interested in this trend. And what we see is that influences what we actually write. So if you go back to 2007, it's just our US energy team has been consistently writing about shale and unconventionals and fracking and thematic research. And then recently, since 2010, we've been writing about it internationally and in our oil services team. And then this year, the effect has spread even further. And we now have our transportation teams writing about it, our industrials team, our chemicals team, and several more to come, which I can't tell you because our compliance department would kill me. So it's just a really, really broad trend. And that's the overview of that section of my presentation. And I'm going to go into the details of what has really been affected. But I guess maybe the best way to start that is to turn it over to you. What do you think, sitting in the audience, is the single most asked about implication of shale today when we look globally? Does anybody have any thoughts? Go for it.
Yeah, I would say the possibility of the export of LNG from the US to
Yeah.
markets.
Yeah, that's a key one.
African or Russian energy project.
Yeah, that's a key one, and I'm glad you asked that because I'm going to come on to it. The other one that everybody's looking at today is what is the scope for international shale to replicate what's going on in the US? And you're right, because I think that's the second most asked question is when will the US start exporting this incredible volume of shale gas? And the kind of controversial answer I'm going to give you to that question later is it actually already is, which you might find surprising, given that it doesn't have any major LNG facilities yet. So look, internationally, the prize for shale is huge. 70% of shale resources are said to be found in international countries outside of the US. And what we're showing here is the set of petrophysical data in conjunction with Neftex, who we looked at this with, about the recoverable resource per cubic meter of shale in different countries around the world. And what I've plotted on this map is just the 15 best shales by that metric. And you can see the color of the circle here is how good the shale is. So the blue dots are the richest. So in the Bakken, you can get almost 0.7 gallons of oil out of each cubic meter of shale. And there's a lot of cubic meters out there. So the Bakken obviously is a US shale, but if you look to the Bazhenov in Russia, this is an enormous million square kilometer resource covering all of western Siberia. It's about the size of the Gulf of Mexico and Texas put together, so pretty big. And Russia seemed keen to incentivize ExxonMobil and Rosneft to go and develop it with concessions that are being discussed in the Kremlin, right now. And then also, one that's been really highly discussed is the Vaca Muerta shale in Argentina, right? So you can't flog a dead horse, but you can frack a dead cow or a Vaca Muerta. And so you can, in principle, if the Argentinian government don't expropriate your acreage and Repsol don't sue you for picking it up. These are kind of interesting because these are two shales that you can see interest in exploring them, but if you look at some of the others in our top 15 shales here, a lot of them are in Iran, Iraq, Kuwait, Algeria, Libya. These are countries with over 100 billion barrels of conventional resource. And so, maybe you can ask, well, is it really realistic that these governments would want to go in and target the unconventionals rather than producing from what they have in their proved reserves today? And that's one of three pushbacks that investors often have about international shales. That's one of them. And the second two I'd point out is, if you talk to a petrophysicist, they'll often tell you, look, at a shale can just be thought of as a textural description, they say sometimes, i.e., it's just a organic, rich, laminated mudstone. And within that, there can be a huge variation in the particle size between clays, silts, non-organic compounds, absorbed organic material, porosity, permeability, fracturability, and the breadth is really striking. So just because you can frack a well and get 2,000 barrels of oil equivalents a day out of it in say the Eagleford, doesn't mean you can rock up halfway around the world in the Baltic Basin and just sink an equivalent well and hope it will flow. And the third point here about kind of the challenge for these international shales is, economically, will they work with the costs potentially being higher? So there have been challenges in the global picture. Also in Europe, we've seen some of the best prospects challenged by various factors. So this is data from a report last year just showing the recoverable resource, I should emphasize the technically recoverable resource rather than economically recoverable, in different European basins. And Poland, France kind of lead the curve here. France has helpfully banned hydraulic fracturing, which is clearly a major technical impediment to getting any of it out of the ground. And there's, if you look at it, challenges with really all of these shales, not insurmountable, but significant. And so you'll see on this slide, Poland is said to be the most prospective by resource, 187 trillion cubic feet, compared to about, I guess that's 10 years of European gas demand. But the first wells have highlighted that, again, this is going to take learning and technological improvement in order to get these shales working. So what I'm showing here is the initial flow rates from wells drilled in the Baltic Basin over the last 12 months. And the first wells they tried to frack actually had some problems with proppant placement. They couldn't get the proppant into the reservoir and prop the fractures open and so that gas could flow out of them. But the first well that really produced real results that we could look at was this Libyan well, which started off at 2.2 million cubic feet a day before declining to a steady state of about 0.5 million cubic feet a day. And we can compare that with the 30-day initial production rates you get on shales in the United States. And what you see is that that's well below the 2 to 3 to 4 to 14 million cubic feet a day you get in the Fayetteville, Barnett, Haynesville, Marcellus when those wells are fracked. So that's been disappointing to some investors. And I'm always concerned that if I stand up and give a talk to a large room of people, there'll be people who are big supporters of European shale in the audience, and they'll start throwing things at me. But this is a concern for investors, and I want to be constructive and say what I think could move this forwards and allow the investment community to get a little bit more positive around these European shales. And the first is just to make the point that nobody expects the first well to deliver blockbuster knockout results, right? Everybody knows there's a learning curve here. And if you look in the United States and you index all of the shale plays we've seen come into development, you can look at the typical flow rates between the first 10 wells and the wells around well number 1,000 drilled in the play. And what you see is that typically by 1,000 wells drilled, you're producing 160% more per well than in the very first 10. And so if you apply that to what we've got here, you can get up to maybe 1.5 million cubic feet a day from the Baltic Basin. And that, that's still below the 2, 3, 4 to 14 thresholds we see in the United States, but it's a step in the right direction. And while we aren't currently assuming any real material volumes of shale gas in the European supply mix by the end of the decade, what could change that would be if they can shift that technology curve and really deliver some punchy well results. And I think there's a talk later that's kind of going to focus specifically on that. Just to mention it briefly, what we're looking to is, one, can you put some harder proppants into the reservoir? Because it looks like last year a lot of the proppant that they used to keep the fractures open got crushed under the formation pressure. And that's why the fracs didn't stay open and why the conductivity wasn't very good. And secondly, can they find zones that are a little bit more clay? So the problem they've had in some of these Silurian shales in Poland is the clay content. Clay is very ductile, it's harder to frack. If you imagine taking a hammer to a piece of glass and a piece of clay, you can kind of imagine one cracks really nicely and easily and one just makes a dull thud and doesn't release any gas or make any fractures, right? So what a lot of people have said is the Silurian shales targeted last year had up to 50% clay. And if you move into the Cambrian or Ordovician shales in the same area, you could lower that. So that could be an interesting area. So, we'll see more results on this, and it's not a conclusive thing yet, but as I said before, we need a shift in the technology in order to get really positive. The interesting thing, and this is where I think it gets fascinating to look at the broader implications of unconventionals, is that you don't need shale gas to work in Europe for shale gas to impact Europe. And this complex chain of events I'm about to describe to you, starting in the US, resulting in what I was talking about earlier in response to your question, US shale gas is actually coming into Europe already indirectly. In the power sector in the United States, it's become about 50% more cost efficient to burn gas than coal in the earlier half of this year with the depression in the gas price. And what that's done is it's promoted coal to gas switching by utilities companies. And in fact, the gas being used in power generation in the United States is about 5 billion cubic feet a day higher this year than last. And that's a significant amount, right, in a 65 billion cubic feet a day market. What that does, though, is it frees up that coal so that it can not be used in power and can be exported. And so really interestingly, you're seeing 25% reduction in the coal price coming out of the United States since the start of 2010, and about 3 billion cubic feet a day of coal has been freed up, and about 300, so I'm talking in gas terms here, so 300 billion cubic feet a day of gas equivalent coal has been freed up, and European gas demand is down, you'll note the coincidence here, by around 3 billion cubic feet a day since last year. And what's happening is coal imports to Europe from the US have just surged. It's about 70% since last year. And so you've got this really interesting implication, which is that there's no LNG capacity in the Gulf Coast yet to export the US shale gas. But what they can do is switch it from gas to coal, export the coal, burn the coal in the European power sector, and then free up gas in Europe so that you have an effect of what we're calling synthetic LNG or teleported shale gas coming into Europe from the United States, which is, I think, really, really interesting. And if you want to kind of ask a little bit more about this towards the end of the presentation, it actually has a profound consequence for what we think will happen in European gas markets at the end of the year. And if you don't believe me, sorry, this is probably the most complex slide you'll see all day. But I just wanted to make the point that in a typical year, does this work? There's a really neat correlation between temperatures and gas demand in different European countries. And the warmer countries use less gas and the colder countries use more gas. And this year, that correlation is going exactly the wrong way around. You know, something is different in gas markets this year in Europe. And what you find actually explaining the different country trends is the year-on-year change in coal consumption, especially in the power sector, and there's also a correlation with changes in US coal imports. So, you know, we really think there's this teleported shale gas coming into Europe in an interesting way. It's not just gas markets, it's refining. You'll see on the left-hand side of this page the utilization rates of refineries in the different OECD regions. And, you know, it's no I'm surprised today that refining is a beaten down industry in the OECD. Utilization rates are around 80% versus 87% before the financial crisis. But look at this decoupling. In the United States, refinery utilization has bounced right back. It's attractive to refine products with the cheaper inputs and the cheaper fuel costs, and that's a marked contrast to Europe and Asia. And in fact, this has allowed the US to go from a net oil product importer in the mid-2000s to a net oil product exporter, you see on the right-hand side here, and that's a phenomenal swing in events. But it's not just the amount of refining that's going on that's been influenced by shale gas, it's the type of refining as well, because shale produces very light natural gas liquids. And so what that does is it increases the demand for heavier products in the United States to put into the refineries to blend with these NGLs, and decrease the demand for the very, very light products to be imported. And so when you look at the change in imports of oils this year, you find that, you know, that the blends that the US are importing more of are these heavy oils like Canada, Colombia, some of the Saudi Arabian blends, and what they're importing less of, it's the Nigerian light crude, the Algerian light crude, the Angolan light crude. And so this is actually distorting the different pricing of these crude oil blends in the international market. And on the right-hand side here, you can see something like Bonny Light, which is, you know, classic West African blend light going into the United States. The premium for this has gone right down from $3 in the middle of last year to flat, because they don't need as much of this light crude anymore. And that's actually a benefit to European refiners in the Mediterranean who can pick up this cheaper Nigerian crude today. And there's also implications for the chemicals industry, which I guess in the interest of time I won't run through in too much detail, but you find exactly the same trend there, an advantaged chemicals industry in the United States, and you know, up to 50% EBIT improvement just from the lower input costs. The next section of broad implications looks at the demand trend. It's kind of a surprise to a lot of people that shale, which is kind of sort of as a supply side phenomenon, can come and impact demand trends as much as they have. But here's something I want to show you that's really interesting. If you look on the left-hand chart here, you'll find there's a really good correlation in the United States between the imports of containers on the West Coast and diesel demand, shipping goods around the country. So you import your goods from China and then you take them by truck around the country. And in 2011, this correlation completely breaks down. You find an increase in distillate demand and a decrease in container imports. And what's going on here is, you know, there is some other driver of trucking demand for diesel, and when you think that it takes 1,000 truck trips possibly to create all of those well paths David was showing you earlier, it's no surprise that if you look in North Dakota, you look in Texas, you look in Oklahoma, all of those charts on the right-hand side, you see this big uptick in demand for trucking relative to non-trucking vehicle miles. And you don't see that outside of the shale plays. if you're an NOC, the biggest worry you have about all of this is that shale gas supply erodes the demand for fuel in the United States, and you aren't able to sell as many products. Pakistan makes quite an interesting example of this. This is a country in the top chart here that's gone from 0% natural gas vehicle penetration in the early 2000s to 80% today. And as it's done that, you'll see that the gas demand has increased rapidly, the oil demand has ticked down, and it's today 400,000 barrels a day, stable in line with what it was a decade ago. And there are NOCs worrying, could this happen in the United States and take out vehicle demand in what is the biggest market globally? This is where I start to become a bit of a misery guts and say, sorry, it's not the start of US energy independence. The first reason is that the OECD is a much harder place to get significant NGV penetration than other regions globally. So if you look at the top 20 countries by NGV usage, only one of them is an OECD country, and it's Italy. And there's real barriers to adopting this in the United States. Does anyone want to guess what NGV penetration is in the US today? Correct. It is exactly 0.05%, right? And so if you think, just to take 1% of demand away, you've got to go from 0% NGVs to 1% NGVs, which doesn't seem that tough, but when you only turn over your vehicle fleet at 7% a year, it means that 1 in 7 vehicles that you buy in the United States has to be an NGV just to offset 1% of demand. I'm going to, since you got my first question so well, I'm going to ask if you know what the Ngv purchase percentage is in the US today. It's not 1 in 7, I'll tell you that. It's about 1 in 600, so quite a long way to go, right, in adopting this technology. So if you can't put the shale gas into your cars directly, can you use GTL to convert it into liquids, then put that in your cars? Again, sorry to be negative about whether you could do this. Look, if you take the analogy of Pearl GTL, which is the Qatari project that Shell developed, it took about $19 billion of capex to get 140,000 barrels a day of diesel production in Qatar. So to offset 3.5 million barrels a day of diesel demand in the US, you'd have to spend, assuming no inflation in the cost from doing all of this, something like $600 billion, which would be about equivalent to a whole year of oil industry spending globally, just to get diesel offset by GTL projects. And plus, you've got the risk that I can't see the US allowing GTL projects like this to be developed. They're pretty industrial and pretty expansive and nasty, right? So Pearl in Qatar is about the size of Hyde Park as an industrial complex, and I just can't see that happening in Texas as easily, and not without significant delays. So that's me being negative on the demand side. I'm now going to offend you further by being negative on the supply side as well. Having a bit of problems with the clicker. Oh, there it goes. It would be great if we could get US energy independence out of this shale production. And we have seen an incredible fall in the gas price as a result of it. So that the question that everybody is asking today is, will shale oil ramp up and due to US oil market fundamentals what shale gas did to gas market fundamentals in the United States? And the first reason we don't think that that's likely is the volumes are just completely incomparable. Gas markets price locally. The US gas price is determined by US supply and demand. And within that, the Barnett, the Haynesville, the Marcellus account for about 30% of US gas supply. When you look at shale oil, on the other hand, oil prices off a global market. And then the Bakken and the Eagle Ford are a much, much lower percentage of that, just 2 to 3% today, if you look at all of US liquids. Secondly, the overall resource potential is just lower for the oils. If you think about fracking shale, methane is pretty much the smallest hydrocarbon you can extract, right? It's CH4. If you imagine getting 8 hydrocarbon out of a shale, it's a much bigger molecule to extract, and what that means is that this is the resource curve on the bottom here for gas. You can get about 500 TCF, or 25 years of supply, from the gas resources at a $5 an MCF gas price. And then when we look to oil, it's 30 billion barrels, which sounds like a lot, but that's only 1 year of global supply as opposed to 25 for gas. The third point is that there's a lot more elastic supply in the oil mix. So OPEC account for, 31 million barrels a day today, and together with Russia, that puts them at 50% of the world's crude oil supply. This group of countries, all of them run budget deficits once you get to $80 Brent. And for that reason, we think that you'd get cuts long before you got down to that level. And then finally, this is the theme I want to finish the presentation talking about. It's the change in technology over time and what it does to the ability to produce these unconventionals. Before I dive into it, David, how am I doing for time?
We've got another 10 minutes.
Okay, perfect, good. Look, I was talking before about learning curves and how initially the productivity per well starts improving as you find the sweet spots of a resource, as you learn how to frack the wells best. And that's what we've seen in pretty much every shale play in the United States. The thing is that eventually the technology runs its course, and I'm going to use this phrase, the rocks start to win, right? So eventually you move out of the sweet spots of a resource and the productivity per well stops rising and it starts to decline. And this is exactly what we see in Montana in some of the Bakken shales being produced there. So production is down from about 100,000 barrels a day in Montana's Bakken shale to about 60,000 barrels a day today. And if you look on the right-hand side here, you can see these are the most productive wells that were drilled in the resource. And today, we're drilling the X's right around the outside, way away from the sweet spots. And that's why the productivity per well has begun to decline. And so while the technology is important, our view is that eventually the rocks win. And you see this best in the single best analogy for what technology does in learning curves globally. This is something that I think a lot of people don't know about from investors that I speak to. If I told you there was a country that had once had oil production of about 12 million barrels a day, and then it declined to 6 million barrels a day, and then they started using horizontal wells and fracking and a reorganization of their upstream to drive production back up to an all-time high this year, everybody would assume I was talking about the United States, right? But in fact, if you look at Russia, which is hopefully the next slide, this is exactly what happened with them since the end of the 1990s. There's their production in the black line. The first horizontal wells and the first fracks were conducted, admittedly in these sandstone reservoirs, so not like the shales of the US today. And that allowed production to accelerate back up, quickly at first, slower eventually. And this year it's running around 10.3, 10.4 million barrels a day as a result of all of this unconventional activity. I guess unconventional, you could argue that, but unconventional in the sense that it's an unconventional production technique. What does this tell us about the US today? Well, there's actually some interesting analogies you can look at, because as you see in the blue line here, the United States is just at the inflection point of this curve, and there are people calling for US energy independence who think the straight line just continues and continues and continues, and we think probably it levels off. So I want to look at some of these Russian productivity numbers. I think they're really interesting. I've tried to fit them all on one chart, which may be confusing, but hopefully if you bear with me. First, have a look at the dotted line here. That blue dotted line. That's the average production per. Oh no, it's not. Have a look at the dashed blue line. That's the average production per new fractured well in Russia. And originally, that added 140 barrels a day when you came in and started fracking Russian wells. And today, if you look at what you produce by fracking a Russian well, it's about 70 barrels a day, i.e. the learning curve has declined. And the same is true if you look at horizontal wells. Originally, you were producing 900 barrels a day per horizontal well. It's been variable, but today you're producing more like 360 barrels a day. And so if you look at all of the new wells drilled in Russia, in the mid-2000s, you were getting 300 barrels a day. Today, you're getting just 270. And what this tells us is that declining productivity can cause you to have to do something really not very attractive from an investment perspective, which is to just go crazy with the amount you start spending. And so you've seen an enormous escalation in the costs and the capital intensity of Russian upstream production, which this is a fear potentially for some of the US, but if you look in particular at the green and the blue bars on the bottom here, you can see the use of these new technologies, hydraulic fracturing, horizontal wells, accelerating at around 8% a year over this time frame. But they're being completely outpaced by just drilling more, employing more rigs, working over old wells. And what this tells us is that, yes, you've got a growth in these new technologies, but what's growing faster is just doing more rather than doing better. And that's the risk for when a resource curve matures. And you start to see this in the US as well, with the number of horizontal wells and the number of frac stages per well. So this is something to watch and where we fear the industry could be going. So overall, it's great to get another 2 million barrels a day of unconventional supply by 2015. But for us, it doesn't change the long-term outlook in oil markets, which is that we stay roughly where we are from here, and then supply begins to decline, spare capacity in OPEC begins to decline, and we expect quite sharply rising oil prices towards the end of the decade. Contrary to what's priced in today by the futures market, which is a decline back to 90. So that's the kind of Bernstein bear view about oil markets and what the ultimate impact of unconventionals will be. I'm really happy to take any questions.
Okay, a couple of things, particularly for Alistair Graham, who's been scribbling, probably written down every number that Bernstein, that Rob offered us. Just remind you that the video of all the speakers and their slides will be online, hopefully by the end of the week. So there's no need to practice your undergraduate skills of taking copious notes from boring professors. It's all available on the internet. Okay, anybody got any questions, please? Yeah, here. And please wait for the mic and say who you are.
James Elston, Palladian Energy. Good presentation. I think probably correct conclusion here. Just a couple of points. On terms of tight oil, nearly all the tight oil plays are actually producing from a carbonate. Yeah. Which is associated with organic rich shales. So it's the petrophysics really, if you like, of that carbonate, of that limestone, that matter more than in shale. These curves on productivity declining, that's interesting. But the thing that matters is finding and development costs, and generally through time efficiencies are continuing to improve. And therefore F&D costs are continuing to come down. If F&D costs are upticking, then I agree you have a problem. But just looking at raw peak production from these resource plays doesn't really give the full picture.
Yeah, I think that's a really good point. And the F&D cost is something that we look at really closely. And what you see in Russia is that F&D costs have been rising. So for Lukoil and Rosneft, they're running up to I think about $8 a barrel for Rosneft and 14 for Lukoil, which might indicate who has more access to resources from the Kremlin. But you're right. I mean, if you look in the United States, as you're saying, then F&D costs have been ticking down, and 100% agree that that's the key thing to watch. And if you look at even these forecasts for the oil price, and which are based on supply in the next 3 or 4 years, we stay constant from here for about 5 years, because you do see some moderation of that capital intensity in the global resource curve for the next 5 years as these unconventional volumes come on. So I think that's a good point. Thanks.
Thanks, Rob. I take it there's nobody from the Kremlin actually here, so that's I mean, I think the F&D cost is an interesting one, because of course if you look at deep water, if you look at resources reserves today, there's a kind of deep water and unconventionals, not battle, but two threads. I mean, deep water F&D costs are almost out of sight. I mean, you can routinely be looking at north of $200 million to drill an exploration well in deep water because of high rig costs, and there's absolutely no sign of those coming down, as you guys at Bernstein have told us. Anybody else? Okay, Rob.
Great.
Thank you very much.
You.
Thank you.